Hello and a warm welcome to our dear clients and value viewers. I'm Mike Ricalde from the Wealth Management Group. Today, we will be sharing with you our views regarding the market based on current and available data, as well as our forecast for year 2023. Joining us this afternoon is RCBC's Chief Economist, Mr. Mike Ricafort. Without further delay, I'm pleased to introduce Mr. Mike Ricafort. Hello, Mike.
Hi, thank you, Mike, and thank you, everyone, for attending our briefing.
How are you?
I'm fine, thank you.
It's nice. Well, Mike, it's nice to finally do this face to face after quite a while.
Yeah.
Anyway, well, to start, Mike, based on our year-end forecast and forecast for 2023, what would be the catalyst that would propel our economy to hit our GDP target?
Well, first, number one is the further reopening of the economy towards greater normalcy. No more restrictions. The best manifestation of that, wearing of masks is just voluntary, except for a few cases like for public transport, for ambulances, and for medical facilities. But other than that, it's voluntary. So it's almost back to normal, our economy. No more restrictions. So we can only dream of this day 1 to 2 years ago, and finally we got it. But the only thing that would offset this would be higher prices or inflation, as well as higher interest rates, risk of recession in the US, which is the world's biggest economy, some continued lockdowns in China. We've seen it just lately. There's a situation in Disneyland Shanghai. So because of the zero COVID tolerance by China, so that's slowing things down. So yeah, but we're all starting from a low base, and imagine we've seen in the right recovery path. Finally, tourism, foreign tourism, local tourism, that started since February, and we already had more than 1.8 million tourists already. So that's gonna add to foreign tourism revenues. And imagine many industries and businesses, especially the hard-hit ones, they would already be in the right recovery path. And many other industries, especially in the countryside, and practically around the country, as well as the schooling in person has been resumed since August 20, 100% already since November 2 for public school. So imagine many other businesses and industries, especially MSMEs, would benefit from that. So that's our biggest story, actually. So, and we're coming from a low base. In view of the, we still had some large lockdowns, some pockets of which last year. So we're coming from a low base and low denominator. So expect growth between 6% to 7% this year, and that could still be sustained at least 6% for the coming years.
All right. Thank you, Mike. Now, Mike, as we all know, inflation has remained stubbornly high. Do you think BSV's action is enough for inflation to hit its target of between 2 and 4%?
Well, realistically, inflation would start to ease, most especially in the early part of next year. We all know that the peak in oil prices, the highest for other commodity prices, happened in March of last year. NYMEX oil was around $130 per barrel. It started 2022 at 75. Now it's doing at 89. And the last time we saw high oil prices was in July when it was $123. So now it's still lower by more than $30. And so therefore year-on-year inflation, since that's the reckoning, compared to a year ago, that would start to decelerate, so to speak, especially starting the first quarter onwards, starting from a low base. So imagine, we're targeting towards 4% initially. So there's a good chance to be near the upper part of the target of 2 to 4%. And hopefully by 2024, we'll go back to 3 to 4% levels. So yeah, that's the reckoning, and that's also true for U.S. and global inflation. In view of that premise, we would see a deceleration on the year-on-year growth in prices. So yeah, that's something to look forward to. As long as, of course, it's imperative to stabilize the peso, because the exchange rate, well, the year-to-date, the depreciation is still around more than 14%, close to 15%. So that still adds to import prices and overall inflation. So it's very important to stabilize both inflation, and it starts with it's important to stabilize the peso. So so far the government has a good track record for the past 18 years. So given the tools and other measures that's available.
Okay, that's noted, Mike. Now, since we're in the topic of central banks, how do you think the Fed will behave? Do you think it'll move in line with consensus?
But so far, we have seen the latest signals, as widely expected, November 2 US time zone, 75 basis point hike. That's the fourth straight jumbo hike in the same extent. So meaning every 6 weeks, 4 times. So that's 300 basis points practically in that's practically 3 to 4 months time. And the signals from the Fed is that the upper end or the ceiling may still be higher than what the markets are estimating. It's conditional upon inflation in the US going down from 40-year highs, and they have already reiterated their strong desire to bring it to the target of 2%, which is still far because the current rate is 8.2%, among the highest is January 1980. So that's the most important data in the world right now as far as Fed rate funds or Fed rate hikes are concerned, because that's the primary motivation for aggressive Fed rate hikes in the quest to bring down inflation towards a target of 2%. So yeah, that would set the tone around the world. The US Central Bank, well, the guidance right now and what the markets are pricing is a ceiling of around 5% or a little over 5% by the other part of this year till early next year. So our policy rates locally would follow that, and that would also determine the fortunes and the trend of the US dollar versus the global currencies.
Got that, Mike. Well, Mike, at this point, I'd like to talk specific asset classes, beginning with oil. Currently, as we all know, oil has hovered below, or perhaps you can say settled below $100 ever since the Ukraine invasion. Should China reopen, I'm pretty sure demand will pick up. Do you see oil testing the $100 per barrel level again?
But so far, it hasn't done so. Oil has been stable at 80 levels, currently doing at 89. It reached more than a month ago in late September. It reached a low of 76. That's almost the same as the end 2021 level of 75. And the last time that we saw oil above, well, at least significantly above 100 was in July, middle of July at $123 when there were talks of a possible reopening of the Chinese economy. China is the second biggest economy of the world. It's also the biggest importer of oil and many other commodities. That's why some of the continued lockdowns in China may have also helped in bringing down the prices of oil and other commodities. So, but nonetheless, it's really the central banks doing their job, especially the Fed and many other central banks around the world by raising rates. They try to slow down economic activities to the point of having the risk of recession in the US, which is the world's biggest economy, and that has contributed also in bringing down commodity prices, especially oil. So, in fact, the latest move by OPEC to cut production by 2 million barrels per day in November, that seems to be a defensive measure on their part, some insecurity on the part of oil producers, being able to prevent the price of oil from going down. So, but of course, we need to also consider the fact that the Russia-Ukraine war is still ongoing, and winter is yet to come. But so far, so good. It's still manageable, and maybe there's a good chance that many buyers have already hedged their requirements, learning from the lessons of last year and prior to the war. So, then again, you have to anticipate again if things get better on the COVID lockdowns in China, if that would be a factor when it comes to the price of oil. Let's see if it would go back again close to 100 or above 100, but so far we haven't seen that one.
Okay, thank you, Mike. Now, moving on to the equity space, particularly the local equity market, we've seen the market, uh, or the local market has been under constant pressure, due to foreign selling amid interest rate hikes in the US. Now, what do you think would bring back buying interest in the local equity market?
But first, it all starts and ends with the fundamentals. Since the economy is further reopened towards greater normalcy, everything is in the right recovery path. The missing parts of the recovery, foreign and local tourism, and in-person schooling. Now that it's 100% in-person for government schools, but blended learning is still allowed for private schools since November. And for the first time in more than 2 years, in-person schooling was allowed since August 22. So all systems go. Well, I'm talking about, of course, in view of the full reopening of the economy, that would translate to higher sales or revenues, higher income and valuations for the listed companies. So that's a primary consideration. It just happened that that would be offset by higher prices or inflation that would eat into their profits, their margins, and their income and overall valuations, and also higher interest rates that would lead to higher financing or borrowing costs. That would also be some drag on their bottom lines. But nonetheless, that's in the big picture. It's better than nothing. We can only dream of this scenario. We can only wish of this scenario of being free economically. You can freely work, do business, no restrictions, you can travel and do whatever you want economically. No more restrictions. So we can only dream of that, and that has been fulfilled already. So that's the biggest blessing, so to speak, for the economy. But although we just have to manage with the risk of recession as well. That's slowing things down in terms of slower trade, exports, investments, FDIs, and also that would have indirect effects also on the local economy. We have seen already some job cuts in some exporters actually. That's in response to the slower global demand. So those are the important considerations. But nonetheless, the markets both in the US and in the Philippines, they have bottomed out already in last month in October. And so far, we have seen, well, that's already an opportunity also for long-term investors, so to speak, given the relative bargains that have presented themselves.
All right, that's duly noted. Then moving on to the US, Mike, you and I have seen earnings reports. No? Although they're below consensus, they're not at recessionary levels. So how do you see the S&P 500 behaving in the coming quarters?
So the pattern has been similar. The near 2-year lows happened in the early part of October, similar to our local markets. So we're moving also in line with the US stock markets or Wall Street. So far, most of the corporate results and earnings have been better than market expectations, generally. Although realistically, we have seen already some lowered guidance or forecast for, say, the fourth quarter, the latter part of this year, in view of higher inflation, higher Fed funds rate, higher bond yields, or that's increasing borrowing costs or financing costs, and of course the risk of recession as companies also adapt in the US. And but nonetheless, it's as well, the key data would still be it's really important for the Fed to achieve its objective of significantly bringing down inflation, so that it would lessen its aggressiveness. That has been signaled by the Fed in its latest decision to hike rates, in the sense that, through the guidance, the ceiling may be higher than market estimates, but they're now willing to do smaller rate hikes as early as December 14 or maybe the next meeting after that. And that's already, well, and at the same time also, it also warned of a premature pausing of the Fed funds rate. So it's really, well, it all starts and ends with bringing down significantly inflation. If that is fulfilled, that's going to help everything in terms of market sentiment and valuations.
All right. Now, Mike, you mentioned bond yields, and rate hikes. That brings me now to my next question, which is about fixed income. And we all know that rates are quite high. No? So are we seeing peak levels at this point?
So far, we have seen U.S. Treasury yields among, especially the long-term tenors, at the 15-year highs. Those are the highest levels since the global financial crisis, is a subprime crisis in the U.S. around 2007, 2008. So we have yet to see, though, the ceiling, in as much as the Fed has yet to see the ceiling also in its Fed funds rate. So it would be a function of that more than anything else. So it's really very important that the aggressive Fed rate hikes would be effective in bringing down significantly inflation, so that bond yields would also follow in that respect. And there's another nuance to the markets, is that, well, that's adding to the volatility lately. That's why it went to 15-year highs, is that central banks like the Bank of Japan, they have been using US dollars to intervene, to support the yen, and they have been using also and selling some of their US Treasury holdings into it. So that's why the yields went up. And other central banks are doing the same as they smoothen or intervene in the respective currency markets, stabilize both their currencies and inflation, in as much as the BSP has been doing the same. So that's kind of complicating a bit the bond markets. But then again, well, the currencies are moving based on the aggressiveness of Fed rate hikes. So if inflation starts to go down in the US, that would lessen the aggressiveness of the Fed rate hikes, and hopefully that would also lessen the volatility in the currency market, and also lessen the strength of the US dollar. And therefore, that would also reduce the need for central banks around the world to use their US dollars and to use their US treasuries by selling US treasuries and having their dollars and defending their respective currencies like the yen and other global currencies. So yeah, that's our view. We have yet to see the inflection point or the peak. So we have to be kind of patient with that. But the opportunities are already presenting themselves.
All right. Thank you for that answer, Mike. Now, since you touched on BOJ intervention as well as dollar yen, my next question is, can you give us more color on how the BSP has defended the Philippine peso?
So far, they have used at least 3 tools.
Okay.
Well, interest rate hikes.
Yes.
Well, at the very least, they have been signaling. And they have done so actually. They have made various rate hikes in previous months. And they have signaled already that, well, at least in an unprecedented manner, the local authorities have been transparent by saying they're providing some guidance already to the markets of hiking the local policy rate hike by 0.75, matching the latest Fed rate hike, that enabled to maintain comfortable interest differential. So that's one potent way to stabilize the peso, to increase the relative attractiveness of the peso compared to the US dollar by way of higher interest rates. And secondly, outright intervention in the market. They have been there at 59 on the 6th week already, or for more than a month already, since last week of September. And they have effectively capped it there at 59. Now it's doing at a little less than that, a little less than 59, at the 58 level. So it has been effective because, and other measures that are available include also liquidity management tools. They have tried to siphon up some of the excess pesos through the weekly BSP term deposit facility and 28-day securities auctions. So they have increased the volumes in an effort to get more pesos that would otherwise be used to buy dollars. So that has been helping the peso also, as well as other measures such as requiring tighter reporting and more frequent reporting on foreign exchange transactions. So, among many other measures, the government had a good track record in stabilizing the peso for 18 good years at the previous record high of 56.45, 2004, 2005, and the last time we saw the record high of 56.45 was September 1 this year. So they have the track record. Well, at least that's good signaling.
All right. Mike, just a follow-up question regarding Forex. It's widely known that both the BPO sector as well as OFW remittances have contributed significantly to the growth of the economy, as well as the stability of the peso. Now, apart from these two sectors, do you see any other sector or any upcoming sector that will bring in additional dollar receipts to the country?
Well, every year, Well, especially lately, the OFW remittances contribute at least $35 billion per year. BPO revenues contribute about $30 billion per year. And the Philippines is number 2 in the world in BPO. It's number 1 in call center. For remittances, the Philippines is number 4 in the world after India, China, and Mexico. And even 5 years ago, there was even a point that the Philippines overtook Mexico. So you add the two on a yearly basis, especially for this year, 35 billion from remittances plus 30 billion from BPO revenues, that's 65 billion. That's at least enough to cover for the net imports or trade deficit that could reach 60 billion this year. So not many other countries have that. So the Philippines has been fortunate to have, especially the fast growth in BPO revenues. Imagine that only started $1 billion per year in 2004. And we have seen a steady growth in remittances despite the pandemic, surprisingly, because of the social function to support the dependents here since the pandemic, and also to higher inflation would mean more remittances, more support. Well, other sources, of course, with the resumption of foreign tourism. Before the pandemic, it has been contributing at least $5 to $7 billion per year. So we have to be kind of patient with that. Especially, we have yet to see more tourists, especially from countries with restrictions, such as from the big groups of tourists from China, South Korea, and other countries. So, but it's moving towards the right direction. We have to be patient, but it's moving there. So, the other earnings may include, of course, we have seen foreign investors coming in, FDIs reaching 10.5 billion dollars last year. That's a record high, but we have yet to catch up with the rest of the region, in as much as the need to catch up for our foreign tourism revenues and numbers with the rest of the region. So those are the biggest sources of opportunity going forward.
Okay. So tourism is something that we need to look out for.
Yeah.
All right.
I guess, Mike, that's all the time we have for this session, and I would like to thank you for sharing your insights with our viewers. And I'm looking forward to doing this again with you soon. Before we end, should you have should you have comments or suggestions regarding this presentation, please feel free to contact your respective relationship managers. And should you want us to produce more content for you, please feel free to reach out to us. And on behalf of Mr. Mike Ricafort and the entire wealth management team, I'd like to thank you for watching, and I hope to see you all very soon. Thank you. Thank you, Mike.